You know what amazes me every day? The way most people think about taxes. They act like the tax code is some kind of punishment from the heavens, something they just have to accept and pay. Meanwhile, there's a whole other group of people, the wealthy, who are playing a completely different game. And I'm going to tell you right now, this isn't about cheating. This isn't about doing anything illegal. This is about understanding the rules that Congress wrote into the tax code on purpose. See, here's what nobody wants to tell you. The tax code isn't just a list of what you owe. It's a massive instruction manual for how to build wealth. It's loaded with incentives, strategies, and perfectly legal ways to keep more of what you earn. But here's the problem. Nobody teaches regular people this stuff. You know who learns it? The rich. They've got teams of accountants, tax attorneys, and wealth managers who spend their entire careers studying these strategies. And you want to know the really frustrating part? Most of these strategies aren't that complicated. I'm serious. Once you understand the basic principles, you'll wonder why your high school didn't teach you this instead of making you memorize the quadratic formula. Because let me tell you, knowing how to save $50,000 in taxes is a lot more useful than knowing how to solve for X. So today, I'm going to break down exactly how the wealthy pay zero taxes or close to it, and I'm going to do it in plain English, no jargon, no fancy accounting terms, just the straightforward truth about how the game really works. And more importantly, I'm going to show you which of these strategies you can actually use, starting today, no matter what your income level is. Now, before we dive in, I need to be crystal clear about something. Everything I'm about to tell you is completely legal. These aren't loopholes that are going to get you audited. These are strategies that Congress deliberately put into the tax code to encourage certain behaviors. They want you to invest. They want you to start businesses. They want you to save for retirement. And they're willing to give you massive tax breaks to do it. The problem is that most people never learn about these incentives. They go to work, earn a paycheck, and watch the government take a big chunk before they even see it. That's called earned income. And let me tell you, earned income is taxed at the highest rates in the entire tax code. It's the worst possible way to make money from a tax perspective. And yet, that's how 90% of Americans make their living. The wealthy, they figured out a long time ago that you don't want to earn income. You want to own assets. You want investments that appreciate in value. You want businesses that generate cash flow. Because all of those things are taxed at much lower rates, or in many cases, not taxed at all until you decide to sell. Let me give you an example that'll make this crystal clear. Imagine two people. Person A works hard, climbs the corporate ladder, and ends up making $400,000 a year as a senior executive. Sounds pretty good, right? Wrong. That person's getting absolutely hammered on taxes. After federal income tax, state income tax, Social Security, Medicare, all of it, they're probably taking home less than $250,000. They're losing more than a third of their income to taxes. Now let's look at person B. Person B makes the same $400,000, but they make it through long-term capital gains. Maybe they invested in stocks years ago, or they own rental properties, or they sold a business. Whatever it is, they're making $400,000 in capital gains. You know how much tax they pay? At the federal level, it's capped at 20% plus maybe 3.8% for the net investment income tax. That's it. They're taking home over $300,000. That's $50,000 more than person A, and they're both making the same amount of money. Now here's where it gets really interesting. The truly wealthy don't even do that. They don't sell their assets and pay capital gains tax. They use a strategy that's so powerful, it's almost hard to believe it's legal. It's called buy, borrow, die. And once you understand it, you'll never look at wealth the same way again. Here's how it works. Step one is buy. You acquire assets that appreciate over time. Stocks in great companies, real estate in growing markets, businesses that generate value. Anything that increases in worth as the years go by. Now here's the key. You don't sell these assets. You hold on to them. Forever if you can. See, the IRS only taxes you when you have a realization event. That's fancy talk for selling something. If you buy Apple stock at $50 and it goes to $200, you haven't made any taxable income. It's just sitting there growing in value, completely untaxed. The IRS can't touch it until you sell. Now, you're probably thinking, okay, but what if I need money to live on? I can't just let my money sit in stocks forever. And that brings us to step two, borrow. This is the genius part. Instead of selling your assets and paying capital gains tax, you borrow money using your assets as collateral. Let's say you own $10 million worth of stock. You walk into a private bank, not your local branch, but one that caters to wealthy clients, and you say, I'd like a loan for $2 million. They look at your $10 million in stock and they say, sure, no problem. We'll give you $2 million at 3% interest. Now think about what just happened. You got $2 million in cash to spend however you want. You didn't sell anything, so you didn't pay any capital gains tax. And because it's a loan, it's not considered income, so you don't pay income tax either. You just got $2 million tax-free. But wait, you say, don't I have to pay back the loan? Yes, eventually. But here's the thing, the interest rates on these loans are usually lower than the growth rate of your assets. If your stocks are growing at 8% per year and you're paying 3% interest on the loan, you're still coming out way ahead. Plus, that interest, it might be tax deductible, depending on how you structure it. And here's the real kicker, step 3 is die. I know that sounds dark, but stay with me. When you die, your heirs inherit your assets. And under current U.S. tax law, they get something called a stepped-up basis. That means the IRS basically wipes the slate clean on all the capital gains. Let's say you bought that Apple stock at $50 and it's now worth $200. You've got $150 per share in unrealized gains. If you sold it, you'd owe taxes on that $150. But if you hold it until you die, your kids inherit it at the $200 value. They can turn around and sell it the next day for $200 and they pay zero capital gains tax. All those gains you accumulated over your lifetime, they disappear for tax purposes. So let's put this all together. You bought assets that appreciated from $50 to $200. You borrowed against them when you needed cash, so you paid zero income tax and zero capital gains tax. Then you died, and your kids got the assets at $200 with no tax owed. Across decades of wealth accumulation, you potentially paid $0 in taxes on massive amounts of wealth. Now, I know what you're thinking. That's great for billionaires, but I don't have $10 million in stock to borrow against. And you're right. This strategy works best at scale. But here's what you need to understand. The principles apply at every level. You don't need to be Warren Buffett to benefit from this approach. You just need to shift your mindset. Instead of focusing on earning more income, focus on acquiring assets that appreciate. That could be stocks, real estate, even a small business. The moment you shift from being an income earner to an asset owner, you change your tax situation dramatically. Let me tell you about a teacher I know. She makes $60,000 a year, nothing extravagant, but 15 years ago, she bought a duplex. She lives in one unit and rents out the other. The rental income covers her mortgage, and the property has appreciated from $200,000 to $350,000. Now, she hasn't sold the property, so she hasn't paid a dime in capital gains tax. And when she eventually does sell, she can use something called the Section 121 exclusion to shield up to $250,000 of gains from taxes because she lived in it as her primary residence. On top of that, she's been depreciating the rental portion of the property on her taxes every year. Depreciation is this beautiful thing where the IRS lets you deduct the wear and tear on your property even though it's actually going up in value. She's saving thousands in taxes every year, building equity in an appreciating asset, and using other people's money, her tenants' rent, to pay down the mortgage. Is she a billionaire? No. But she's using the same fundamental strategies that billionaires use. She's thinking like an asset owner, not just an employee. And that one decision has probably saved her over $100,000 in taxes across 15 years and built her a net worth that most teachers never achieve. Now let's talk about another strategy, the wealthy use business ownership. And I don't mean you have to start the next Apple or Amazon. I mean any business activity, including side businesses that many regular people could start. Here's why this matters. When you're an employee, you get paid, and then you pay taxes on everything the government lets you keep. When you own a business, you get paid, you subtract all your business expenses, and then you pay taxes on what's left. You're taxed on profit, not revenue. That's a massive difference. Let's say you start a consulting business on the side. You make $30,000 in revenue, but you had $8,000 in expenses, software subscriptions, a new computer, travel to client meetings, marketing costs, part of your home office. You only pay tax on $22,000, not $30,000. You just saved about $2,000 in taxes right there. But it gets better. Business owners can also set up retirement plans that have much higher contribution limits than what employees get. An employee can contribute $23,000 to their 401k in 2024. A business owner can set up a solo 401k or a SEP IRA and contribute over $60,000 in some cases. That's $60,000 they're not paying taxes on today, and it's all growing tax deferred until retirement. And here's something most people don't know. You can convert personal expenses into business expenses if you do it right. That car you drive, if you use it for business purposes, you can deduct mileage or actual expenses. That cell phone bill, business deduction. That home office, you can deduct a portion of your rent or mortgage, utilities, insurance, all of it. Now, I'm not telling you to cheat. The IRS has rules, and you need to follow them. But the rules are actually pretty generous if you're running a legitimate business. The problem is most people never even try because they don't think of themselves as business owners. They think business ownership is for other people, for entrepreneurs and executives. It's not. It's for anyone willing to create value and get paid for it. Let me tell you about a guy I know who works as an engineer at a tech company. Makes about $150,000 a year. Good money, but he's getting killed on taxes. So he started a side business doing technical consulting. He only makes about $20,000 a year from it, but here's what changed. Now he has a legitimate business. He bought a high-end laptop for $3,000 that he uses primarily for his consulting work. That's a business expense. He attends 2 industry conferences a year, which cost about $4,000 total. Business expenses. He set up a home office where he does his consulting work. That's a $5,000 annual deduction for his portion of housing costs. Right there, he's deducted $12,000 from his consulting income. So he made $20,000 but only pays tax on $8,000 of it. Plus, he's able to put $20,000 into a solo 401k because of his business income. That means he's sheltering an additional $20,000 from taxes. Between the business deductions and the retirement contributions, he's saving probably $10,000 a year in taxes just from a side business that takes him maybe 10 hours a week. Is he a billionaire? No. But he's using the same strategies billionaires use. He's thinking like a business owner, not just an employee. And that shift in thinking is saving him $10,000 a year over a 30-year career. That's $300,000 in tax savings. And that's not even counting the growth of the money he's investing in his retirement accounts. Now, let's talk about something that really separates the wealthy from everyone else: real estate. Real estate has more tax advantages than almost any other investment. I'm not exaggerating. The tax code is incredibly generous to real estate investors. First, there's depreciation. When you own rental property, the IRS lets you depreciate the building over 27.5 years. That means if you buy a rental property for $300,000, you can deduct about $11,000 per year for depreciation, even though the property is probably going up in value. That $11,000 deduction can offset your rental income, and in some cases, it can offset other income too. Then there's the 1031 exchange. This is one of the most powerful tools in the tax code. If you sell a rental property and use the proceeds to buy another one, you can defer all of the capital gains taxes indefinitely. You could start with one rental property, trade up to a bigger one, then trade up to an apartment building, then trade up to a commercial property, and never pay a dime in capital gains tax as long as you keep doing 1031 exchanges. And here's the beautiful part. When you die, your heirs get that stepped-up basis we talked about earlier. So you could defer taxes your entire life, building a real estate empire, and your kids inherit it all with no capital gains tax owed. It's completely legal and completely powerful. I know a woman who started with one rental house 20 years ago. She's done 1031 exchanges since then, and now she owns a small apartment building worth about $2 million. Her original investment was $150,000. She's sitting on $1.85 million in gains, and she hasn't paid a penny in capital gains tax. When she dies, her children will inherit that building, and they'll never have to pay tax on those gains either. She essentially created $1.85 million in tax-free wealth. Could you do this? Absolutely. It doesn't require millions of dollars to start. It requires understanding the rules and being willing to think long-term. That's the key, long-term thinking. The tax code rewards patience. It rewards people who build wealth slowly and strategically over decades. Now, let's talk about something that might surprise you: charitable giving. The wealthy donate billions to charity every year, and yes, part of it is because they're generous. But part of it is also because the tax benefits are enormous. If you donate cash to charity, you can deduct it from your taxes up to certain limits. But here's what the wealthy do that's smarter. They donate appreciated assets. Let's say you bought stock for $10,000 and it's now worth $50,000. If you sell it, you owe capital gains tax on that $40,000 gain. But if you donate the stock to charity, you get a $50,000 tax deduction and you never pay capital gains tax on the $40,000 gain. You just avoided thousands in taxes while also doing something good. And it gets even better with something called a donor-advised fund. You can dump a huge amount of appreciated assets into a donor-advised fund, get the tax deduction immediately, and then distribute the money to charities over time. This is how billionaires get these massive tax deductions in 1 year. They're not giving away all the cash immediately. They're giving it to their own donor-advised fund, which they control, and then distributing it over many years. Now, I'm not saying you should only give to charity for tax reasons. That's cynical. But if you're going to give anyway, you might as well do it in the most tax-efficient way possible. If you're donating $5,000 a year to your church or local food bank, consider donating appreciated stock instead of cash. You'll get the same deduction, but you'll avoid capital gains tax. It's a win-win. Let's talk about another strategy that's incredibly powerful: tax-advantaged retirement accounts. I know this sounds boring, but stay with me. The wealthy max out every single tax-advantaged account available to them, and then they go further. For most people, it's a 401k and maybe an IRA. But for business owners and high earners, there's a whole menu of options. There are defined benefit plans that allow contributions of $200,000 or more per year. There are cash balance plans. There are even strategies like private placement life insurance, which is basically a tax-free investment wrapper that only the ultra-wealthy can access because it costs millions to set up. But here's what you can do right now, regardless of your income. First, max out your 401k if you have one. In 2024, that's $23,000 or $30,500 if you're over 50. That money grows tax-free until retirement, and it reduces your taxable income today. If you're in the 24% tax bracket, that's saving you over $5,500 in taxes right there. Second, fund a Roth IRA if you're eligible. The contribution limit is $7,000 in 2024, or $8,000 if you're over 50. You don't get a tax deduction today, but it grows completely tax-free forever. When you retire and start taking money out, you pay zero taxes on it, zero. If you put $7,000 a year into a Roth IRA for 30 years and it grows at 8%, you'll have over $850,000, and every penny of that can come out tax-free in retirement. Third, if you have kids, open a 529 plan. Contributions grow tax-free, and distributions for education are tax-free. Some states even give you a state tax deduction for contributions. It's free money. The wealthy know something that most people don't. The magic isn't in finding some exotic tax shelter. The magic is in consistently using all the tools the government already gives you. A 401k, a Roth IRA, a 529 plan, maybe an HSA for health expenses. If you max out all of those, you're sheltering $40,000 to $50,000 per year from taxes. Do that for 30 years, and you're talking about millions of dollars in tax-free or tax-deferred growth. And here's the thing that kills me. Most people don't do this. They leave free money on the table because they don't think it matters. Oh, I can only afford to put in $100 a month. Guess what? That's $1,200 a year. Over 30 years, at 8% growth, that's over $150,000. And if it's in a Roth IRA, that $150,000 is completely tax-free. You're telling me you don't want an extra $150,000 tax-free in retirement? Now, let's talk about state taxes, because this is another area where the wealthy have an advantage. You know what 7 states don't have? Income tax. Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. 0 state income tax. If you live in California and you're making $500,000 a year, you're paying about $50,000 a year in state income tax. If you move to Texas or Florida, that $50,000 stays in your pocket. Now, I'm not saying you should uproot your life just to save on taxes, but if you're retired, or if your work is remote, or if you're starting a business, why wouldn't you consider this? Over 10 years, that's $500,000 you're giving to the state that you could keep. That's real money. And don't think this is just for the rich. I know teachers, nurses, small business owners who retired and moved from high-tax states to no-tax states. They're not millionaires. They're just people who did the math and realized they could live better in a state that didn't take 5% to 13% of their income every year. The wealthy also use something called income shifting. This is where you move income from high-tax people to low-tax people. Let's say you own a business and you're in the 37% federal tax bracket. Your teenage kid has no income and is in the 0% tax bracket. You can legitimately employ your kid in your business, pay them a reasonable wage for legitimate work, and that income is taxed at 0% instead of 37%. You just saved 37% in taxes on that money, and you're teaching your kid about work and money. Or let's say you're in a high tax bracket and your parents are retired in a low bracket. If you're going to give them money anyway to help out, consider hiring them as consultants for your business if they have expertise you can use. Now that money is a business deduction for you and taxable income for them at a much lower rate. Is this aggressive? Maybe. But it's completely legal as long as the work is legitimate and the pay is reasonable. The IRS allows this. They just want to make sure you're not making your 5-year-old a $100,000 a year consultant. Use common sense, document everything, and you're fine. Now, I want to talk about something that people are really afraid of: offshore accounts and foreign investments. When you hear offshore, you think of criminals hiding money in Swiss bank accounts. But there are completely legal and legitimate reasons to have assets outside the United States. For example, if you're a business owner and you're doing business internationally, it might make sense to have a foreign entity for tax efficiency. Or if you're retired and you want to live abroad part of the year, having accounts in that country makes practical sense. The key is disclosure. The IRS doesn't care if you have foreign accounts as long as you report them. It's the hiding that gets you in trouble. I'm not going to go deep into this because it gets complicated quickly and most people don't need it. But the point is that the ultra-wealthy use international structures to minimize taxes, and it's legal as long as it's done right. It's just another tool in the toolbox. Let me tell you something that most people don't understand about the tax code. It's not designed to be fair in the way you might think. It's designed to incentivize certain behaviors. Congress wants you to invest in businesses so they make capital gains, tax rates lower than income tax rates. They want you to own real estate, so they give you depreciation deductions. They want you to save for retirement, so they give you tax-deferred growth in 401(k)s and IRAs. The tax code is basically a giant instruction manual for how the government wants you to behave, and if you follow the instructions, you get rewarded with lower taxes. The problem is that most people never read the instructions. They just do what everyone else does: work a job, earn a paycheck, pay taxes, and then they complain that the system is rigged. Is the system rigged? In some ways, yes. It's definitely tilted in favor of asset owners over wage earners. But here's the thing: you can choose to be an asset owner. Nobody's stopping you. You don't need to be born wealthy. You don't need connections. You just need to understand how the game works and start playing it. I think about this a lot when I'm looking at companies to invest in. I'm always asking myself, what are the incentives here? What behavior is this company rewarding? The same principle applies to taxes. The government is telling you, if you behave this way, we'll let you keep more of your money. And yet most people ignore the message. Let me give you a concrete example. Let's say you have $100,000 sitting in a savings account earning 4% interest. You're making $4,000 a year in interest, and you're paying taxes on all of it. If you're in the 24% tax bracket, you're losing $960 to taxes. Your after-tax return is only 3.04%. Now, what if you took that same $100,000 and invested it in a broad stock index fund? Historically, stocks have returned about 10% annually. You'd make $10,000 in the first year. But here's the key: you don't pay taxes on that $10,000 until you sell. It's growing tax deferred. And when you do eventually sell, you pay capital gains tax, which is only 15% for most people, not 24%. Over 30 years, the difference is staggering. The savings account, even with compound interest, grows to about $324,000. The stock investment grows to about $1.75 million. That's more than 5 times as much money just from understanding how taxes work and choosing a more tax-efficient investment. And let's be real here that $1.75 million is actually worth even more because of the tax advantages. If you're strategic about when and how you sell, you might pay 15% capital gains tax instead of 24% ordinary income tax. That's a 9% tax savings on every dollar of growth. over millions of dollars, that's hundreds of thousands in tax savings. This is why I get so frustrated when I hear people say the rich don't pay their fair share. Define fair. The rich are following the exact same tax code that's available to everyone. They're just better at using it. And most of what they're doing isn't even that complicated. It's basic stuff: own assets instead of just earning income, use retirement accounts, donate appreciated stock instead of cash, borrow against assets instead of selling them. You can do all of that. You might not be able to do it at the same scale as a billionaire, but you can do it. And over a lifetime, it'll save you hundreds of thousands of dollars in taxes. Now, let's talk about something that nobody wants to discuss: audit risk. People are terrified of the IRS. They think if they take too many deductions or use too many strategies, they'll get audited and destroyed. Let me tell you something. The IRS audits less than 1% of tax returns. Your chances of getting audited are incredibly low unless you're doing something obviously fraudulent or you're making millions of dollars. And even if you do get audited, so what? If you've documented everything properly and you're following the law, an audit is annoying but not catastrophic. You sit down with the auditor, you show them your records, and you explain your deductions. If everything's legitimate, you're fine. The IRS isn't trying to trap you. They're just making sure you're following the rules. The wealthy aren't afraid of audits because they have good accountants and they keep good records. That's it. That's the secret. If you're taking a home office deduction, keep records of your square footage and your expenses. If you're deducting business mileage, keep a mileage log. If you're donating to charity, keep the receipts. It's not complicated. The IRS publishes all their rules. It's all public information. You can literally read the tax code and see exactly what's allowed and what isn't. The problem is that the tax code is 70,000 pages long and written in language that only lawyers can understand. That's why you need a good accountant or tax advisor. But here's what kills me. People will spend $5,000 on a vacation without thinking twice, but they won't spend $500 on a good accountant who could save them $5,000 in taxes. It makes no sense. A good tax professional is one of the best investments you can make. They'll find deductions you didn't know existed. They'll structure your finances in more tax-efficient ways. They'll save you far more than they cost. I've used the same accounting firm for decades. They're not cheap, but they're worth every penny. They've saved me millions in taxes over the years, and I'm not special. I'm just a guy who understands that taxes are a significant expense, and minimizing that expense legally is smart business. Let's talk about health savings accounts, or HSAs, because this is one of the most underused tax strategies available. If you have a high deductible health insurance plan, you can contribute to an HSA. In 2024, the limit is $4,150 for individuals or $8,300 for families. That money is tax deductible going in, it grows tax-free, and if you use it for medical expenses, it comes out tax-free. Think about that. It's the only account in the entire tax code that's tax deductible going in and tax-free coming out. Not even a Roth IRA can make that claim. An HSA is actually better than a Roth IRA for retirement savings if you use it right. Here's the strategy. Max out your HSA every year, but don't spend the money on medical expenses. Pay for your medical expenses out of pocket and let the HSA grow. Over 20 or 30 years, that account can grow to hundreds of thousands of dollars, all completely tax-free. Then, in retirement, you can use it for medical expenses, which you're going to have anyway. And here's the kicker. After age 65, you can withdraw from an HSA for any reason without penalty. You'll pay ordinary income tax on non-medical withdrawals, which makes it just like a traditional IRA. But if you use it for medical expenses, it's still completely tax-free. It's like having a retirement account that gives you optionality. I know people who've built six-figure HSAs over the years. It's all tax-free money sitting there for when they need it in retirement. And they did it by contributing $4,000 to $8,000 per year and letting it compound. It's not magic. It's just using the tools the government gives you. Now, let's talk about something controversial: life insurance as a tax strategy. I'm not talking about term life insurance, which is what most people have. I'm talking about permanent life insurance with a cash value component, and specifically something called private placement life insurance, or PPLI. This is a strategy that only the ultra-wealthy use because it's expensive to set up, but the tax benefits are enormous. Here's how it works. You put a large amount of money into a life insurance policy, sometimes millions of dollars. That money is invested inside the policy, often in hedge funds or other alternative investments. The gains grow completely tax-free inside the policy. You can borrow against the policy for living expenses, and those loans aren't taxable. And when you die, the death benefit goes to your heirs, completely tax-free. It's basically a way to turn highly taxed investment income into tax-free life insurance proceeds. The IRS allows this because technically it's life insurance. But in reality, it's a tax avoidance vehicle for the wealthy. Now, I'm not saying you should run out and buy PPLI. For most people, it doesn't make sense. It's complicated and expensive. But I'm telling you about it because this is how the game works at the highest levels. The ultra-wealthy aren't paying taxes on their investment gains because they're using structures like this to shield the money. For regular people, there are simpler versions of this strategy. You can buy a whole life or universal life insurance policy with a cash value component. You overfund the policy with extra premiums, which grow tax-deferred inside the policy. Then, in retirement, you can borrow against the cash value for income. Those loans aren't taxable, and if you structure it right, you can access that money without ever paying taxes on the growth. Is this better than just investing in stocks or bonds? It depends. Life insurance has fees and expenses that can eat into your returns. But if you're maxing out all your other retirement accounts and you're looking for additional tax advantage space, it's worth considering. The key is to work with a good advisor who understands these strategies and can help you determine if it makes sense for your situation. Don't just buy a policy because some insurance salesman tells you it's a great deal. Do your homework, understand the fees, and make an informed decision. Now, let's talk about something that I think is really important, teaching your kids about taxes. One of the reasons the wealthy stay wealthy is because they teach their children how the tax code works from an early age. They don't just hand them money. They teach them how to earn it, invest it, and protect it from taxes. If you have kids, start teaching them about taxes now. Show them your pay stub and explain why there's a difference between gross pay and net pay. Open a Roth IRA for them as soon as they have earned income. Teach them about compound growth and how taxes affect investment returns. These are lessons that will serve them for their entire lives. I'll tell you a story. I know a family where the parents run a small business. They started employing their kids in the business when they were teenagers. The kids did real work, filing, data entry, helping with marketing. The parents paid them a reasonable wage, and the kids put that money into Roth IRAs. By the time those kids graduated college, they each had over $30,000 in their Roth IRAs, and it was all completely legal and tax efficient. Now those kids are in their 30s. That money has grown to over $100,000 each, and it'll be worth well over $1 million by the time they retire, all tax-free. And it started because their parents understood the tax code and taught their kids how to use it. This is how generational wealth is built. It's not about being rich. It's about being smart with money and passing that knowledge down. If you're teaching your kids how to save and invest, but you're not teaching them about taxes, you're only teaching them half the lesson. Let me tell you something else that's critically important: timing. The timing of when you realize income and when you take deductions can make a huge difference in your tax bill. The wealthy understand this, and they use it to their advantage every single year. Here's a simple example. Let's say you're a business owner and you know you're going to have a big income year. Maybe you landed a huge client or you sold a business. You know your tax bill is going to be enormous. What do? You accelerate deductions and defer income. You buy equipment you were planning to buy next year and you buy it this year. You prepay expenses. You max out retirement contributions. You make charitable donations. You do everything you can to reduce your taxable income in that high-earning year. Conversely, if you're having a low-income year, you might defer deductions to next year when you'll be in a higher bracket and they'll be worth more. You might accelerate income by collecting payments early or selling investments that have gains. It's all about managing your tax bracket. This is called tax bracket management, and it's incredibly powerful. The tax code is progressive, which means you pay different rates on different chunks of income. If you can keep yourself in a lower bracket by timing your income and deductions, you can save thousands of dollars. Let me give you a real example. Say you're married filing jointly and your taxable income is usually around $180,000. That puts you right at the edge of the 22% and 24% brackets. If you can shave $10,000 off your income by maximizing 401k contributions or making charitable donations, you save $2,400 in taxes. That's real money. Now multiply that over a 30-year career. If you save $2,400 a year for 30 years, that's $72,000. And if you invest those savings at 8% annual returns, it grows to over $270,000. That's $250,000 just from smart tax bracket management. The wealthy do this on a much larger scale. They have entire teams of accountants and lawyers whose job is to time income recognition and deductions to minimize taxes. They'll structure deals to close in different tax years. They'll defer bonuses. They'll accelerate or defer capital gains depending on their overall tax situation. You can do a simplified version of this on your own. Just keep track of where you are in the tax brackets and make smart decisions about timing. It doesn't require a law degree. It just requires paying attention. Now, let's talk about something that I find fascinating, how the wealthy use losses to offset gains. This is called tax loss harvesting, and it's one of the smartest strategies you can use as an investor. Here's how it works. Let's say you bought stock A for $10,000 and it's now worth $15,000. You have a $5,000 gain. If you sell, you owe capital gains tax on that $5,000. But let's say you also own stock B, which you bought for $10,000 and it's now worth $7,000. You have a $3,000 loss. If you sell both stocks in the same year, your net gain is only $2,000. You owe taxes on $2,000 instead of $5,000. You just saved yourself about $450 in taxes by harvesting the loss to offset the gain. But here's where it gets really smart. Let's say you still believe in stock B long term. You just sell it to harvest the loss, wait 31 days to avoid the wash sale rule, and then buy it back. You've taken the tax loss, but you still own the stock. You've effectively converted a paper loss into a real tax benefit without changing your long-term investment strategy. The wealthy do this every year. They're constantly harvesting losses to offset gains. They might have a portfolio worth $10 million with lots of winners and a few losers. They'll sell the losers to generate losses, use those losses to offset gains from the winners, and then rebuy similar positions after the wash sale period. It's a tax arbitrage play, and it's completely legal. You can do this too. If you have a taxable brokerage account with individual stocks or funds, look at your losers every year and consider harvesting those losses. You can offset up to $3,000 of ordinary income per year with capital losses, and any excess carries forward to future years. It's free money from a tax perspective. Now, let me talk about a strategy that people really don't understand, qualified opportunity zones. This is a relatively new part of the tax code created in 2017, and it's an incredible deal if you know how to use it. Here's the basic idea. The government designates certain low-income areas as opportunity zones. If you invest capital gains in a qualified opportunity zone fund, you get massive tax benefits. You defer the capital gains tax until 2026 or when you sell the investment, whichever comes first. If you hold the investment for at least 10 years, any gains from the opportunity zone investment are completely tax-free. Let me repeat that. Completely tax-free. You can invest your money, watch it grow for 10 years, and pay zero capital gains tax on the growth. That's insane. The wealthy are pouring billions of dollars into opportunity zones because the tax benefits are so good. And you can too. There are opportunity zone funds you can invest in, or if you have a real estate project in an opportunity zone, you can invest directly. I know a couple who sold a business for $500,000 and had a huge capital gains tax bill coming. Instead of paying the tax, they invested the gains in an opportunity zone fund that's developing affordable housing. They deferred the tax until 2026, and if they hold the investment for 10 years, any gains are tax-free. They turned a $500,000 investment that would have been hit with a $100,000 tax bill into a potential $1 million tax-free return. Is this risky? Sure. Opportunity zones are in low-income areas for a reason. The investments carry risk. But if you're going to owe capital gains tax anyway, this is a way to defer it and potentially eliminate taxes on future growth. It's worth considering. Now, I want to talk about something that's really important for people who are nearing retirement or already retired, managing your tax situation in retirement. Most people think that when they retire, their tax bill goes away. Wrong. In many cases, retirees are paying just as much in taxes as they did while working, sometimes more. Here's why. When you retire, you start taking withdrawals from your 401k and IRA. Those withdrawals are taxed as ordinary income. You also might be taking Social Security, which can be taxable depending on your other income. You might have pension income, rental income, investment income. It all adds up. The key is to manage your withdrawals strategically to minimize taxes. This is called tax-efficient withdrawal strategies, and it can save you tens of thousands of dollars over a 20 or 30-year retirement. Here's the basic framework. You have 3 buckets of money in retirement: taxable accounts, regular brokerage accounts, tax-deferred accounts, 401k, traditional IRA, and tax-free accounts, Roth IRA, Roth 401k. The question is, which bucket do you pull from first? The conventional wisdom used to be that you pull from taxable accounts first, then tax-deferred, then tax-free. The idea was to let the Roth grow as long as possible since it's tax-free. But that's not always optimal. A smarter strategy is to manage your tax bracket. If you retire before you start collecting Social Security and before you have to take required minimum distributions from your IRA, you might be in a low tax bracket. This is the perfect time to do Roth conversions. Here's how it works. Let's say you're 62, retired, and living off savings in your taxable account. Your income is low, so you're in the 12% tax bracket. You could convert $50,000 from your traditional IRA to a Roth IRA and pay only 12% tax on it. That money is now in the Roth, growing tax-free forever. Compare that to waiting until you're 75, collecting Social Security, and taking required minimum distributions from your IRA. Now you're in the 24% bracket. If you convert at that point, you're paying double the tax rate. By being strategic and converting when you're in a low bracket, you can save tens of thousands in taxes over your lifetime. The wealthy do this all the time. They're constantly looking at their tax brackets and asking, how can I move money from tax-deferred to tax-free when it's cheapest to do so? It's like buying something on sale. You're paying the lowest possible price, in this case the lowest tax rate, to convert money to a more favorable tax treatment. Another strategy for retirees is to manage your Social Security taxation. A lot of people don't realize that Social Security benefits can be taxable. If your provisional income, which is your adjusted gross income plus half of your Social Security benefits, exceeds certain thresholds, up to 85% of your benefits can be taxable. The thresholds are surprisingly low, $25,000 for single filers and $32,000 for married couples. If you're collecting Social Security and also taking distributions from your IRA, you can easily blow past these thresholds and end up paying tax on your Social Security benefits. One way to avoid this is to do Roth conversions before you start collecting Social Security. By getting money out of your IRA and into a Roth early, you reduce your future required minimum distributions, which reduces your provisional income, which reduces the taxes on your Social Security. It's all connected. I know a retired couple who did this brilliantly. They retired at 62 and lived off their taxable brokerage account for 5 years. During that time, they converted $250,000 from their IRAs to Roth IRAs, paying only 12% tax on the conversions. Then, when they started collecting Social Security at 67, their IRA balances were much lower, their required minimum distributions were smaller, and they paid almost no tax on their Social Security benefits. They saved over $100,000 in lifetime taxes just by being strategic about the timing. This is the kind of planning that makes a huge difference in retirement. It's not about making more money. It's about keeping more of what you have. And the tax code gives you all the tools to do it. You just have to know the rules and be willing to plan ahead. Let me tell you about another strategy that's incredibly powerful: estate planning. Most people think estate planning is just about writing a will and avoiding probate. That's part of it, but the real value in estate planning is minimizing estate taxes and creating a tax-efficient transfer of wealth to the next generation. Under current law, the estate tax exemption is about $13.6 million per person in 2024. That means if your estate is worth less than that, you don't pay any federal estate tax. But if you're over that limit, the tax rate is 40%. That's a huge bite out of your wealth. The wealthy use all kinds of strategies to reduce their taxable estates. They give away money during their lifetime using the annual gift tax exclusion, which is $18,000 per person per year in 2024. They set up trusts, grantor retained annuity trusts, charitable remainder trusts, dynasty trusts. They use valuation discounts. They use life insurance trusts. It's a whole world of complex strategies designed to minimize estate taxes. Now, most people don't need to worry about estate taxes because they're not worth $13 million. But here's the thing: the estate tax exemption is set to get cut in half in 2026 unless Congress extends it. If that happens, the exemption could drop to around $7 million per person. Suddenly, a lot more people are going to be subject to estate taxes. If you're in that range, maybe you own a business or real estate, or you've been a good saver and your net worth is $5 million to $10 million, you need to start planning now. Because once that exemption drops, you could be facing a huge tax bill when you die. The basic strategy is to use the current high exemption while you still have it. You can gift assets to your kids or to trusts now while the exemption is high and lock in that tax benefit. Even if the exemption drops later, gifts you made under the old higher exemption are grandfathered in. I know a family that did this recently. The parents owned a business worth about $8 million. They knew the exemption was going to drop, so they gifted the business to their kids in 2023. Because they did it before the exemption dropped, they used the full $13 million exemption and paid zero gift tax. If they'd waited until 2026 when the exemption drops, they would have owed taxes on $1 million to $2 million of that gift. They saved hundreds of thousands of dollars just by acting before the law changed. This is the kind of planning that makes a difference for wealthy families. It's not about dodging taxes illegally. It's about understanding the law and acting while the law is favorable. And right now, the law is extremely favorable for estate planning, but that window is closing. Another estate planning strategy is the use of life insurance. Life insurance proceeds are generally income tax-free, but they're included in your taxable estate if you own the policy when you die. So what the wealthy do is set up an irrevocable life insurance trust, or ILIT. They transfer ownership of the policy to the trust, which means the proceeds aren't in their estate. When they die, the trust receives the life insurance payout tax-free, and that money can be used to pay estate taxes or distributed to heirs. This is particularly useful if you have a large estate with illiquid assets. Let's say you own a business worth $20 million, but you don't have a lot of cash. When you die, your heirs could owe $3 million to $4 million in estate taxes, but they don't have the cash to pay it. They might have to sell the business just to pay the taxes. With an ILIT, you can have a life insurance policy that pays $4 million to the trust when you die. The trust uses that money to pay the estate taxes, and your heirs get to keep the business. Again, this is advanced planning that requires professional help, but it's the kind of thing that the wealthy do all the time to preserve their wealth across generations. And if you're in a position where estate taxes might be an issue, it's worth exploring. Now, I want to address something that I think is really important, the ethics of tax avoidance. Some people hear these strategies and they think, that's not fair. The rich are gaming the system. And I understand that sentiment. But let me be clear, everything I've talked about is legal. These aren't loopholes that are going to get closed next year. These are intentional provisions of the tax code. Congress writes the tax code. They could change it anytime they want. But they don't, because these provisions serve a purpose. The capital gains rate is lower than the income tax rate because Congress wants to encourage investment. The estate tax exemption is high because Congress wants to encourage entrepreneurship and family businesses. Charitable deductions exist because Congress wants to encourage charitable giving. The tax code is a tool for social policy. It's designed to encourage certain behaviors and discourage others. And if you follow the incentives that Congress has written into the code, you're not cheating. You're playing the game the way it was designed to be played. Now, should the tax code be simpler? Should there be fewer loopholes? Should everyone pay the same rate? Those are all legitimate policy debates. But as long as the current code exists, you're a fool not to use it to your advantage. Let me give you an analogy. Imagine you're playing Monopoly and the rules say that if you land on free parking, you collect all the money in the middle of the board. Would you refuse to take the money because it's not fair? Of course not. You take the money because those are the rules of the game. That's all we're talking about here, playing by the rules. The problem is that most people don't know the rules. They think the tax code is some mysterious document that only lawyers and accountants can understand. But it's not. It's all public information. You can learn it, you can hire professionals to help you, and you can use it to your advantage. The wealthy aren't smarter than you, they just have better advisors and they're willing to put in the effort to understand the system. There's nothing stopping you from doing the same thing. Let me wrap this up with some practical advice. If you're serious about minimizing your taxes and building wealth, here's what you need to do. First, shift your mindset from being an income earner to being an asset owner. Look for ways to generate income from investments, businesses, and real estate, not just from a job. The tax code rewards asset owners. Second, max out every tax advantage account you have access to. 401k, IRA, Roth IRA, HSA, 529 plan, whatever you can contribute to, do it. These accounts are free money from a tax perspective. Third, if you have any kind of side business or self-employment income, take advantage of business deductions and business retirement plans. Even a small business can generate significant tax savings. Fourth, be strategic about when you realize income and when you take deductions. Manage your tax bracket. If you can stay in a lower bracket by timing your decisions, do it. Fifth, harvest losses to offset gains. If you have investments that are down, consider selling them to generate losses that can offset other gains or income. Sixth, if you're nearing retirement or already retired, be strategic about your withdrawal strategy. Think about which accounts to pull from and when. Consider Roth conversions when you're in a low tax bracket. Seventh, if you're charitably inclined, donate appreciated assets instead of cash. You'll get the same deduction, but you'll avoid capital gains tax. Eighth, if you're a high earner or business owner, consider moving to a state with no income tax. Over a lifetime, it can save you hundreds of thousands of dollars. Ninth, work with a good CPA or tax advisor. This isn't an area where you want to DIY it unless you really know what you're doing. A good professional will pay for themselves many times over. And finally, teach your kids about taxes. This is knowledge that will serve them for their entire lives. The earlier they learn it, the wealthier they'll be. Look, the bottom line is this. The tax code is a game, and the wealthy have figured out how to win. But the rules of the game are available to everyone. You don't need to be a billionaire to use these strategies. You just need to be willing to learn and willing to think differently about money. The biggest mistake most people make is thinking that taxes are this fixed expense that they can't control. That's not true. Taxes are the single largest expense most people will ever have, and they're also the most controllable. With the right strategies, you can cut your lifetime tax bill by hundreds of thousands of dollars, maybe more. That money doesn't disappear. It stays in your pocket. It grows. It compounds. It becomes wealth. And that wealth gives you options. It gives you freedom. It gives you security. So stop thinking of taxes as something that just happens to you. Start thinking of them as something you can manage and minimize. Because that's what the wealthy do. And there's no reason you can't do it too. The rules are all out there. The strategies are all legal. The only question is whether you're willing to learn them and use them. I hope you are, because I promise you, it'll be one of the best investments you ever make.